The middle class is being absolutely destroyed and hollowed out in Canada, and we're going to go through the data that proves this. And not only that, we're going to discuss the past 2 decades, because it's not just been a theme for the past 2-3 years as the mainstream is now coming all about inflation. It's been going on for a lot longer than the mainstream is telling you, and we're going to get into that in a bit. But first of all, let's go into the data that we just had. So the CPI just came out for July, showed that Canadian inflation jumped, and it's raising the prospect for another 25 basis point hike from the Bank of Canada. The only thing that the Bank of Canada is really affecting at this point is psychology, and mainly that is just in the real estate market. Obviously, we've got the real estate bull trap that is in full force right now, coming to the end of that bull trap, it looks like. We'll see how that progresses, but it's very interesting because the Bank of Canada really is just impacting psychology at this point. I mean, just think about what happened last year, for instance, because the real estate market turned on literally a 25 basis point hike. So, you know, obviously now at 5%, it doesn't really make a difference what the Bank of Canada does at this point. And it just goes to show how it's all about sentiment, it's all about psychology, it's not all about interest rates like the mainstream media would have you believe. So just a note there. So anyway, inflation jumped in July. We have to remember, I haven't been through ShadowStats in a while, so I thought I would bring this up. ShadowStats is based on the US CPIU. Canada uses an almost identical basket of ever-changing goods. So the CPIU is the red line here. You can see it's been around 2-3% for the past couple of decades, and then it shot up, nearly hitting 10% here, and that was obviously in 2021, 2022. And now, obviously, if you look at the SGS alternate CPI, which is based off the 1980 CPI, which is a fixed basket of goods, you can see how inflation went to near 20% over the past 2 years, much higher than you or I would think. And this is what I have changed when I come to show my chart, which I produced. I use this ShadowStats data here, so it's just something to bear in mind. So let's get into this inflation data. What the hell happened? So the core consumer price index is the Bank of Canada's main thing that they look at when it comes to deciding interest rates. So that was 3.2%. It was forecast to be 2.8%. You can see right here on this chart that inflation is coming down, and you would expect that, considering, you know, the high amounts of debt that we have in this economy. You would expect inflation to come down when it's at 5%. And the Bank of Canada just does not realize how much they've over tightened here, and I think that is going to become evident over the next sort of 6 to 8 months, where we're going to really see that play out. Because you have to remember, there is a lag effect with all these different things like inflation. You have to remember that obviously when they hike, it takes a long time for that to actually appear. Corporations aren't rolling over their debt month to month, and neither are households. So it's very interesting. So obviously you've got that happening. This core consumer price index, that's ticked up. The month over month consumer price index, the headline, came out at 0.6 here, and it was predicted to be 0.3%. So you can see here the past of what's actually gone on, and you can see that the consumer price headline rate has been very sticky, and it's actually been going up a lot. You've seen these massive numbers where it's gone up month over month 1.4%, and you have to remember the base effects. So what are the base effects? Essentially, the base effects, which are going to come into play now, are when last year it might have been 0% change month over month. So obviously then if it's 0.6% change month over month, that will bring up that yearly number, and you're going to see that happen more and more as we get into the future, because obviously we did actually see months where inflation was actually coming down, like the month that we're in right now. So it's very interesting to note that. For example, if we go back to the August report of last year, it was 0.1%. This year we're at 0.6%. So that's why that year over year number is going up. But you can see that it gets even worse, because in September's report, which was for August, it was minus 0.3%, so actual deflation according to the CPIU, but obviously in reality it wasn't that way. So minus 0.3%. So next month it's likely going to go even higher, especially if we have a high print like we just had. That year over year number is going to march up and up and up. As we get into the other months, it's it's the same sort of thing. So that's how that dynamic works, and I hope that kind of made sense to you. So the year-over-year number for the headline CPI was 3.3%. Who cares? It's just a fictional number. I mean, yes, we can kind of use this as a base, but the government produces these stats and they are complete fiction, as we all know. I mean, I just don't get it, because it's like a taboo subject to talk about the CPI in this way. But the fact is, you ask anybody out there whether they think inflation has only been 8% over the past year, they would say no, Luke, it's been more than like 15-20%. So obviously everybody knows. So why the fuck do we listen to this number and act like this number is something that's accurate? And you have to realize that the central planners at the Bank of Canada, they make all their decisions based off these fake numbers. So if you've had fake numbers for the past 2 decades, well, guess what's going to happen? The monetary policy is just going to be a complete train wreck. And that's exactly what we've had happen. And maybe the actual inflation producing data should be produced by the Bank of Canada. Maybe it would be a little more accurate then. But we know the Bank of Canada is highly corrupted, as we saw that in 2020, 2021. So anyways, it's just very interesting, isn't it, when you really think about it? A lot of talk has been recently about GDP per capita in Canada. And whilst we're on the topic of inflation, what I want to remind you of is that when we're talking about GDP per capita being stagnant in Canada, which is essentially the shared wealth between us all, is essentially been stagnant for the past 5, 6, 7, 8 years. Well, that is using the GDP numbers that have been deflated using a fake CPI. So the fact is, it's way, way worse than that. And the thing is, all these numbers are highly manipulated, and you can sort of use them as a base because they do kind of follow what the actual numbers do. They just massively overstate or understate in terms of inflation. It's understating in terms of GDP. It's overstating because it's deflated using the inflation numbers, which are wrong. And you can see this here with that chart again from ShadowStats. The CPIU is much lower, but it does follow the same trajectory as the 1980s base CPI as well. And if you go to the 1990s base CPI, you can see again they're following exactly the same things essentially. And you know what's really interesting is the real estate market and what's happening here, because obviously real estate is often seen as a hedge against inflation, and that would be true if the real estate was not in a gigantic bubble built on leverage. If you did have real estate which was not in a bubble and people were buying for cash, then yeah, you could say it's a great hedge against inflation. And that's only really if actual wages are growing, because really real estate isn't an inflation hedge. It's just going to grow with what wages are growing at. And that's what a lot of people don't realize. That's how you tell when you're in a real estate bubble, because real estate prices decouple away from wages. And this is what I'm trying to show you with this chart here, is look at the size of this massive bubble. And obviously you've never ever had a decline like this in the entire past series of this index, which goes all the way back to 1970. So that is a mouthful to say the least. But what's really interesting to me about what's going on with the property market and what's going on with inflation is when you look at wages that are actually adjusted for the 1980s CPI, you can see that, look, over the past 20 years, over 20 years, since 1997, we have only seen real wage growth go above 0% twice. And guess when that happened, guys? Have a guess. When did that happen? Oh, it happened in 2008 and it happened in 2020. And was it by 10%? 20%? No. It was by a measly 0.7% in 2008, right here, 2008, 2009. And then in 2020, it was by 1.23%, right here. I had to actually produce this chart because you won't find a chart like this anywhere. But what I want to also highlight to you about this chart is after every time where we have seen real wage growth go up because of government stimulus, what has happened after? You've had almost record declines in real wage growth adjusted for inflation. And if you look at what has happened over the past 2-3 years, it has been unprecedented amounts of declines. So how on earth has this been able to happen in economics? Obviously, if people are losing money, how on earth are they able to afford all the things? How on earth does the economy keep chugging along? And the fact is, the economy is totally financialized, and it has been financialized on debt. So what people have lost with their incomes, they have replaced with this debt. And the problem is, you can only do that for so long, right? It makes sense. Think about it. You know, if your wages aren't going up, you're replacing it with debt. Eventually, your debt payments get to the absolute limit. And we've already seen that. And guys, we didn't just see it with the negative amortization shit that's happening in the housing market right now. Just think about 2020. All those people who deferred their mortgage because of economic catastrophe that hit, and the fact that a lot of people were laid off. We're reaching the utter limits of what can be done to save this bubble. Obviously, they are trying absolutely everything to save this bubble. With all bubbles, it just doesn't work in the end. And it's trillions of dollars of debt that we are talking about. And if the government tried to bail that out or do some sort of write-off in terms of debt, it would never work, because the thing is, the creditors, they have to be paid. So they have to make their money, and ultimately the creditors are the ones that control everything, even control the politicians and the central planners. So you have to realize that. But I just thought that was an interesting tangent to go off on, because, you know, a lot of people don't realize that. And that is why we know we're in a bubble, because we know that people's wages just aren't growing. And ultimately, this is the middle class being hollowed out. This is why so many people are unemployed. This is why so many people are homeless. Obviously, having tons of debt, it doesn't make you very happy. You know, it's just kind of crazy when people think that oh yeah, I'll just get $1 million mortgage, and then you're not going to think like, man, I have a ton of debt and I'm never going to be able to pay that off, because most people aren't going to be able to pay that off. They're relying on the greater fool theory. Interesting what's happening with the Canadian dollar. Canadian dollar has been on this steep decline. It's kind of alarming how fast it declines compared to how long it takes to go up. You know, it takes 2 months to go up, and then it takes a couple of weeks to just write off that entire amount that it's gone up. Obviously, I've been talking about for a long time on this channel about 76 cents. I've said multiple times that I'm buying US dollars at 76 cents. That was where my zone is. Multiple videos on this channel where I've been talking about that, and you know, now we're back in this decline. So it's going to be interesting to see whether it actually holds the trend or breaks down even further, because if it breaks down and then we have an economic catastrophe hit and a liquidity crisis, which is looking incredibly likely, what's going to happen, guys? I don't need to tell you, the Canadian dollar is going to go even lower. It's going to hit even lower lows. So not a good sign for the currency. And obviously there are a lot of things that are going on, and when we look at gold prices, so this is gold versus Canadian dollar, you can see that gold was actually rising against the Canadian dollar. It's actually coming down right now. So it's not actually a bad time to buy some insurance, to buy some gold. I'm a big believer in gold. I believe precious metals, everybody should own them as insurance. You shouldn't just leave it to rich people. You know, if you have over $10,000 worth of savings, then yeah, you should own precious metals. You should have 10, 15, 20% of precious metals in there. That's just insurance. That's just what I do myself, because at the end of the day, if you don't believe in this fiat system and you think one day eventually it's going to be gone, you've just got to have that insurance on your money. And it's really an insurance on government stupidity, which seems to be endless in this sort of thing. So gold is going down. You know, gold can be going down for a variety of factors, but the fact is that there will be a buying opportunity, hopefully anyways, when the stock market crashes, when there's a liquidity crisis, people will sell gold. They'll sell gold, they'll sell oil, they'll sell things that are liquid, and that's why those prices will fall. So in 2020, gold went down by around 20%, and then it was one of the first things to rise when all the government fiscal and stupidity was announced. So obviously that's why I regard it as an insurance policy. I don't regard it as an inflation hedge. And then the Canadian dollar versus the Mexican peso. We've been talking about this a lot because it kind of shows you how the FX markets are digesting what's going on with interest rate differentials. So the reason why the Canadian dollar has declined so much against the Mexican peso is because you can go and buy a Mexican 1-year government bond at 11.36% right now. So obviously I can go into my Interactive Brokers account and I can convert my dollars to pesos and I can buy and get an 11.36% return, and it's pretty unlikely that the Mexican government's going to default on that. Mexico's got a very strong economy, so it's unlikely that they're going to go ahead and default on that, even though there is that slight risk, and obviously it's a higher risk than like the United States and Canada and the UK. So it's very, very different in Mexico in terms of how things work when it comes to government bonds. But that's possibly why. Now, I'm not buying Mexican government bonds. I just want to outline that. And the reason is because when a liquidity crisis happens, everybody is going to be selling those bonds and everybody is going to be coming back to dollars. So you could have the Mexican peso decline loads and then goodbye to your 1-year returns of 11% if then the peso declines like 10-20%, which is possible because we've seen this before, 2008, 2020. So it's just very interesting. But that is part of the reason why there is such flight from even the US dollar, which is kind of regarded as the safe haven currency. A lot of people don't want to admit that. Obviously, I know there's a variety of factors that are leading to the dollar's demise, but that is a very long-term thing, and people act like it's a short-term thing, like it's going to collapse tomorrow, when the DXY is still at like 103, 104 right now. Very strong. It's like at 2-decade highs in terms of strength. So it's very, very interesting. And when you look at Mexican interest rates, obviously, Mexico's interest rates are very high. They're at 11.25%. And inflation is not at 11.25%. So inflation, I believe, is around 7 or 8%, something like that in Mexico. It might even be lower now. I think it's around 5% last time I checked. But anyways, you guys will let me know in the comments and in the chat. So it's very interesting what's going on with currencies. It's interesting what's happening with inflation. We'll continue to monitor it. Anyway, I want to thank you so much for watching. If you've enjoyed this, you might like this video here. You might like this video that I picked out for you here. If you're looking for a VPN, go to expressvpn.com/marketmania. That's the VPN provider I use. I'll see you in the next one. Take care, guys. Bye-bye.